Good afternoon, everyone. Welcome to Let's Talk Real Estate. And today we have Gurpreet with us. Gurpreet is an accountant. Gurpreet, could you tell us a little bit about your firm and what you do?
Sure. I've got my practice in Mississauga, and I'm a chartered professional accountant. I specialize in tax, helping small business owners, individuals file their personal taxes, estate planning, tax planning, and any major tax issues related with real estate is what we want to talk about today.
Yeah, today is definitely real estate. We'll be doing that. And along with us, we also have Amit Kanai, who is co-hosting with us.
Hi there. Amit, also from the Bridge team, so I'll be popping in and chiming in, asking those important tax questions.
Wonderful.
Okay, great. So, Gurpreet, let's talk real estate. I mean, we know that it's one of the biggest area of wealth building, and there are many complex tax rules that involve in this process, right? Now, real estate sales, are they really taxable?
So it's a very good question. Yes, real estate is a major, part of everyone's life. Everyone owns a property, a home. They're always asking me very detailed questions. This particular transaction, is it taxable or not? So let's just break this down into three little categories.
Right.
Every sale of real estate today needs to be reported. The question is, how is it reported? Is it a capital gain? Is it business income? Or is it a principal residence, which qualifies for an exemption?
Wow.
Yeah, so if we break each of these down for your listeners to better understand, I want to say all capital gains are something like a cottage, a second home, a rental property. If it qualifies as a capital gain, the gain on that property, only 50% of that is taxable.
taxable. Now, we have a situation with one of our client, for example.
Yeah.
They lived in their home, is their principal resident, right? They
Okay.
live in their home for 5 or let's say a year or 2 years,
Okay.
and then they decide to rent it out. Would that consider capital gains? Are they exempted? What's going on?
It's a very good question. So in a situation where you have a home that is a principal residence home,
Uh-huh.
and now the change in use has happened where it's gone from a principal residence into a rental property, which is similar to an investment property. In
Right.
that situation, there's very specific rules of how you classify that. And in most cases, it depends on the time you hold the property. Let's say pick a scenario, you've owned a home for 10 years, you
Right.
lived in it for 10 years, and after 10 years, you decide to buy a bigger home, but keep this property and want to rent it going forward. And in this situation, you've rented this property. Now, we don't lose the entire integrity of that home as a principal residence because you've made it into a rental property.
Right.
What would happen in a situation, let's say you sell this home 5 years later, so you held it for 15 years. So CRA allows us to give you a portion of that as a principal residence. And how we calculate or prorate that would be based on the number of years you've lived in that property versus the number of years you've had it as a rental property.
Okay.
Gurpreet, you know what? It's funny we got on this topic because I'm actually in the similar situation as I mentioned to you earlier. Now, I myself only lived in the said property 1 year, but I've already had it rented out now for 2 years. So in that particular situation, it's 66% of the use has been
Principal.
rental. Yeah.
Rental in your case.
Yeah.
There is also
Yeah.
something called a 1 year plus rule,
Mhm.
whereas you owned it for a number of years, you get to add 1 year towards your principal residence. So if you, in your situation, you've owned the property for 2 years
Yeah.
entirely, and you were to sell it today, you actually get a little bit of lead time. It's not that the day you change it, it has to be classified as investment property.
End of the year.
Exactly.
End of the year.
So you get that little bit of plus 1 year rule to it, and then you because people know that you need sometimes time to close a property, time to sell. It's not instant, so there is that 1 year plus rule. But if you were to keep it for a long period of time, let's say
Right.
5-6 years, then obviously we need to take into consideration the number of years you've owned it versus the number of years it's a rental property.
Got you. Good advice.
Good
Thanks.
advice. Now, to all our listeners, please, if you have any question when it comes to real estate and taxation, you can call us direct at 647 931 4701. Feel free to call us anytime. Now, Gurpreet, this lead me to another question. I know many clients will come to me and say, "Hey Jay, I'm moving from my principal residence. I'll change it into a rental property, and I will go and buy another property." However, they want a market evaluation being done at the date of conversion. Could you chime in on that a little bit for me?
So the reason why you want to get a fair market valuation done is because if you want to know the fair market value at the time, if you were to, let's say, not sell it and transfer it to anybody else for that purpose, but if you are going to keep it and rent it out, the fair market value wouldn't play in this situation. It's based on number of years. At the time of disposition is when you really want to take.
That's what you look at. I was of the opinion that how long you live in it, as principal residence, you do the market evaluation. If there is any gain afterward,
No.
that's what you pay on.
No. So there's some really, really good tax planning that can be done.
Uh-huh.
So it's kind of important that, if you are making a major transaction like that, we should consider it. So I have situations where I see parents want to transfer the home to their kids, right? Now, they haven't, they come to me and ask, how should we do this? So it's very important. Either you have two scenarios, you sell it to the kids, right? Or you just keep the property as is and you transfer it to the kids.
Okay.
Right? Now, it's kind of important. There are very, very specific tax results that would happen in each scenario. So one scenario is if we sell it, right? And that's when you want to know the fair market value,
Right.
right? So that what happens is because it was a principal residence up to that date, all that proceeds is tax-free. Now, from that day forward, because we've already locked in a fair market value, anything after that, because the title has changed to the kid's
Okay.
name, that's when, if it's sold years down the road, or now that they're living in it, they can classify it as their principal residence. So it's kind of
Okay.
smart to really look at the whole transaction, look at all the tax consequences. So in a scenario, if you're giving it to the kids, it might be a good idea to sell it to them so that they live in it now and they get the principal resident exemption going forward.
So it's for reporting purposes. That's what
Absolutely.
that. Okay.
So I just wanted to clarify the three types of
Yes,
reporting,
please. Yes, that makes
and then
sense.
kind of indicate how they all apply.
Right.
So we kind of touch base on capital gains, whereas if it's a gain, you get 50% of that as your taxable income.
Right.
Then there is business income. Business income is when we'll go through the criteria a little later down the road. Is that if you're in the business of buying homes and selling, like real estate agents, and you're investing, constantly investing, then you don't get the capital gain. Because you bought it, your intention was to sell and make money, then the whole income, the entire gain is added to your income. You don't get that 50%.
Right. That was one of my next questions about flippers. That's what we call them.
Exactly. So flippers, because you're in the business of flipping,
Uh-huh.
Revenue Canada says, well, it doesn't meet the definition of capital gain because there is
Right.
a particular criteria, and we'll go through that. So you're in a business. So if you're in a business, then you need to report your full income.
Got you.
Whereas principal residence, another point I want to make out is effective 2016, Revenue Canada made it mandatory to disclose your principal residence home. Whereas it's really, we want to educate your listeners that going forward, when you sell your principal residence, you do need to disclose it on your personal residence.
Please note that as of 2016,
Exactly.
Revenue Canada want that being disclosed. It's you gotta
Exactly.
put it there. I think there is a line directly for that on the
Sale of
income
principal
tax
residence.
form,
Yes,
right?
yes.
Okay. What's the major reason for that?
I think that real estate is a very, very important subject matter for tax, and people had an honor system where if it was a principal residence, they didn't have to disclose it before. Now, if we take that into consideration, that means every real estate transaction needs to be
Has
disclosed.
to be disclosed.
It's either one of the three.
Wow.
It's either a principal residence, is it a capital gains, or is it business income?
So people were taking a little bit of advantage on the honor system.
Possibly, it could,
Yeah.
it
Possibly
could be
along
perceived
that
that
line.
way. And Revenue Canada would obviously want to test that.
Right.
Now, another situation. I bought a rental property. It's a brand new home, let's say, right? And it's close. It's about to close.
Okay.
And I really bought it with intention as speculating. I want to flip it. What's involved? What are my obligations to Revenue Canada?
So it's a good question. In that situation, because your intent was to flip,
Right.
this would be considered a business transaction.
Okay.
So let's say you make $100,000 in this scenario. That $100,000 would be added to your income. Now, on that point, I think it's very important. How could tax play? I usually tell all my clients whenever you're making a capital investment, it's always good to talk to your tax professional. See if there's any tax planning. Now, in your situation, it's $100,000 taxable income to you, but there could be some scenarios where we say, okay, Jay, what if we were to add your spouse to this property, right? Maybe we could split this income, right? I mean, there are so many other scenarios where we can take advantage of the tax, but you just need to plan effectively.
So it's not something you can't do after the fact. It's got to be done well in advance.
So that's where you need planning with your financial or your tax, especially tax advisor in the situation like
makes
that.
sense.
Yeah. But on that point, I do want to highlight, we obviously want to take tax into consideration, but we should also think about non-tax issues as well. If you're picking a partner, let's say your brother, sister, or friend to go on a property and say, oh, I can save tax, but please, we need to think about mortgages.
Right.
Does the individual have good credit? Do they bring a strong application?
Right.
Because they may or may not be able to help you qualify, and that defeats the purpose of saving taxes. And then I also want to talk about control. I find that, you know, sometimes now you have a partner, now they also have a say in this matter. So when we make a decision on something like this, it's very important to take into account everything, and then we make a sound decision.
That's very, very important. Actually, when we come back, we will want to discuss a little bit more on this topic. There are many people, as you know, Amit, who bought properties when the market was hot. They bought 3-4 properties, closing, and most of the time, what they do, they with the builder's purchase sale agreement, it is written right in there that they will take it as principal residence. But what happened now? They got it in their name, and they want to sell it right away. They have to pay some HST as well to a certain extent.
Oh, yes,
Right?
because very good question. I see this all the time. What you're referring to is the HST rebate.
Right.
Now, when you buy a home from a builder, there is a clause that you're going to use this as a principal resident. The reason they put that in there is that the purchase price that they're selling you at is inclusive of an HST rebate.
Hold that thought right now. What we'll be doing, friends, we'll be taking a break, and just after the break, we'll come back and discuss that topic. Feel free to call us. We are here to answer any of your questions, or if you want, we will give you Gurpreet's number. You can always call him as well, or visit his website. What's your website, Gurpreet?
The website name is kenaccounting.com, which is KEN accounting.com.
Okay, thank you so much.
Think you have what it takes to bring value to the community? The TCN TV network is expanding and now accepting TV show proposals. Here's an opportunity to build celebrity status and become part of an elite group of community advocates that are focused on building, strengthening, and empowering our community in a positive way. Are you interested in embarking on a new adventure? TCN TV is searching for people interested in opportunities to change the conversation and pave an unforgettable legacy. If you feel you have something of value to offer, send a written show proposal to shows@mytcntv.com.
Hello and welcome back to Let's Talk Real Estate. Again, we have Gurpreet from Ken Accounting with us today, and you have any question or concern about taxation, we'll discuss that. We were talking just now about HST rebate, and could you give us some more details as to what happened?
Sure. When you're purchasing a new home from a builder, please keep in mind it's only applicable for brand new homes from a builder.
Right.
And in this, when you purchase, there's obviously a contract you sign, and that the purchase price is inclusive of an HST rebate. And a lot of people may or may not understand what that means. That means that the house that you're buying it is used for principal residence. If you're going to live in it, you qualify for this HST rebate. If you don't, if you purchase this property and you rent it out or you sell it, then you don't qualify for that. However, if you are to rent it, I do want to say there is a different rebate for that you could apply. It's the rental rebate.
Okay.
But if you do sell it and you don't move in it, you would have to pay the HST rebate back to the government.
Gurpreet, I have a tricky spin to that question. Now, I have a client that he purchased a condo for his personal usage in Markham. Now, there was a delay on that condo. It took 3 years for the condo to be completed. In the second year prior to, after he signed, he actually got a job in the U.S. and moved. So this condo was actually coming up for closing in February of this coming year. So this is a real question right now. He wants to actually sell this condo, and he's worried about his HST,
Rebate.
Yeah, rebate.
So is he going to sell this condo just immediately after closing?
Yep, right after closing.
Yeah, so then it would be subject to HST rebate.
Darn, even though it was the builder gave him a 3-year delay, he had no intention of leaving the country.
There are very, very specific rules around that. CRA does say extenuating circumstances if it prevented you from that. So it's very personal and very case specific.
Case by case.
Whereas there may be some clause where where you can challenge the HST rebate, and we have challenged it on several occasions. But again, it's very specific. So for this audience, it may not help if we talk about one very specific case.
Gotcha. I just thought I'd throw a curveball at you.
No, it's a great question. But there are some exemptions, yes. But,
good to know.
But like I said, extenuating circumstances beyond your control is what they really look at.
Great.
Just to close off on that topic, is it possible, in Amit's situation, that before they put the property for sale, could we go to CRA and say, CRA, could you review this and tell us whether it will be taxed or not?
See, in this particular situation, because the event hasn't happened, there's obviously something called HST ruling, but for HST rebate, it's a little tricky and a little different.
Gotcha.
So I think in a situation like that, it might be best to first consult with your tax advisor to see if you meet the criteria or you don't meet the criteria. In some situations, it might be best to take that into consideration at the time, just before closing. And if you plan on renting it out, so in your friend's situation where it might be a good idea to actually ask him to rent it out and get the rental rebate and wait a year maybe. And then possibly sell it.
Go ahead and sell
So
it.
this is how tax planning comes into
Right,
play.
very important.
That's a great point. Now when it comes to real estate, again, capital gains is something very important. We all know the word capital gains, but could you please shed some light? For example, Amit was saying that you got Florida.
Right. So exactly, I'll give you an example. I have one client that Snowbird. They spend quite a bit of time in Florida, and it's their second home. Now, is that something that they need to report as a rental property, or?
So very good. So there is something called T1135 form, and this is very important. I find a lot of people are not aware of this. If you own a foreign property that costs more than $100,000, you need to disclose that on your personal tax return. So a Florida home, if it costs more than $100,000, it needs to be disclosed. If you don't disclose that, there could be a penalty, and the current penalty is about $2,500 per year of not disclosing that.
Wow.
Oh, wow.
Do they backdate that?
Yeah, so if you didn't file this for 5 years, it's $2,500 per year. But there obviously you can ask for relief. I mean, now you need to give good reasons why you didn't disclose that, and you may or may not get the relief.
Right.
But just on that point, it's very specific when you need to report T1135s, if and only if it's a rental property. There's a huge criteria that goes behind it. If it's a home just primarily for them, they would be exempt from the 1135.
It's an interesting point, because there's entire area of people where just Airbnb their home when they're back at home, and that's kind of the category we're falling into. So it's tricky.
Very tricky. So that's why it's case by case basis, and it's really important to really understand the whole picture, and before we can make a decision. And I find a lot of people are making mistakes where they're taking tax advice from non-professionals. They ask their friends, neighbors, hearsay, and applying that. And in situations when you've applied it, it's really, really hard to fix errors like that. Like we were talking about buying a property, whereas maybe we could have bought it together with a spouse
Right.
or stuff like that. You can't go back and change that.
Well, human nature is as such, right? They will go anywhere else except a professional for advice. I mean, I usually ask them, I said, if you get a serious headache, would you go to a mechanic or would you go to your doctor? No, doctor. You got a car problem, you go to your doctor or mechanic? Similarly, when you got other problems, go to the professional.
Head to the
Exactly.
expert. Yeah.
And a
Right.
proactive approach is probably the best approach I can suggest all your listeners. Before you make capital expenditure or capital investments, just get some advice.
Right.
That could potentially save you a lot of money in taxes, and good tax planning goes a long way.
Definitely.
That's so important. Now, another question.
Sure.
Many clients have 2 or 3 rental properties.
Yes.
Do you advise them to keep it in their personal name, or should you really put it in a corporation? What's the best way to go?
So, to be very honest, I get that asked quite a bit.
Yeah.
But it's very, very specific to the individual. It
Yes.
depends on your long-term goals. It depends on so many factors that you can't use a general formula and apply it to everybody.
Right.
Why? I
Wow.
will say, let's say it's your first property, right? It's a rental property. Now, I would ask, what is your long-term goal? How long do you plan on holding this? Like, is it something that you want to keep it for 5 years, 10 years? Second thing I ask, okay, what is your financial net worth? Can we qualify for a mortgage? Because to get a mortgage on a corporation is very difficult than it is to qualify personally.
I'm glad you mentioned that because we get asked that same question all the time, and we've actually had clients go through the entire process, register the corporation, and the bank says, "Zip, we can't qualify you for
Exactly.
anything."
So it's very individually based. So I ask for long-term goals as the key. And if you want to get into this business, yes, there are some very, very good tax planning techniques in a corporation where you can defer some income, whereas if it's owned personally, all your income is attributed to your personal tax return in the year you receive it. So
Okay.
there's some awesome techniques in the corp, but we need to look at the big picture
Yeah.
and what your goals are. So it's very specific.
That's very interesting to know that.
Yes.
Now, Gurpreet, if I have a property, rental property, I got it for 25 years now, going on 27 years.
Yes.
Is there any capital gains at some time the government may deem that that property is being disposed of, or could I keep it all the way go on until, let's say, debt, and then how do you handle that?
So all the reporting of real estate only happens at disposition.
At disposition. Okay,
Yes.
so you
not
can,
at the time of buy or anything in between.
Okay.
Right?
So they wouldn't say it's deemed disposed after X amount of years or so. and you gotta
not
pay.
not in
trigger
your si-
capital gains.
No,
Okay.
not in your situation.
Okay.
So if you own the rental property for 50 years, well, you don't pay the capital gains unless you dispose of the property. Yeah.
Now, I know that there's a capital cost allowance. If you could shed some light into that and how it affects property in terms of capital gains, how
So-
that really work?
So let's first define what's capital cost
Yes.
allowance. A lot of people
Yes.
may
Yep.
or may not know that. That is what we refer to as the depreciation. Everybody knows what depreciation is based on a car, the value is going down, but in real estate, you also get to take depreciation on a property. Technically, we know properties generally appreciate, they don't depreciate.
Right.
But for tax purposes, you are eligible to take depreciation.
Okay.
And you get to claim that as an expense
Okay.
on your tax return.
Okay.
However, there's a couple of things I do want to caution you. First and foremost, in order to take CCA, which we refer to as capital cost allowance or depreciation, you need to allocate at the time of purchase the value of the land and building separately. That's very, very important because you can only take depreciation on building, not on land.
building, right?
So if you bought this property, you don't know what the allocation is. Now you've made, a little bit of a scenario where we need to first find that out. Secondly, and this is the most important, I don't advise everybody to take depreciation. It's very specific on the individual when we suggest they should and they shouldn't. The reason is, let's say you have income in the year, you take depreciation to reduce your rental income. By the way, there is a limit. You can only take depreciation to reduce the rental income to zero. You can't create a loss.
Negative.
Okay.
Okay. Secondly, now you've been taking depreciation year over year because you didn't want to allocate that income in your personal taxes. At the
Right.
time of sale, all the depreciation you've taken over the years, is recaptured.
Oh, so you take it up front, you pay for it later.
Exactly. And then anything above that would be capital gains in a scenario if it was a rental building. So you don't get away with just taking depreciation.
Okay.
So the question really is, which is better, and it's very individually based, but more than often than not, in the year of sale is when you're going to have the biggest income. And do you really want to add a significant amount of recapture in that year, because you're going to be obviously in the high rate of tax and probably pay a lot higher tax if you were to calculate it that way.
It's more similar to a tax deferral mechanism than anything else.
In this case, it all catches up to you very well, and it's attributed
one way or
in
the
the year.
next year, you can't get away from the tax, man.
There are some scenarios where I do advise, and I think it might be a good idea, but again, it's very, very specific. One is, let's say you have cash flow issues in a particular year, and you don't have the funds to pay the taxes. Well, you say, you know what, it's better to take this this depreciation in the year to make your taxes lower than to have a tax payable and not be able to pay. Right? And you can worry about that problem when you sell. So there are some very specific scenarios when it does make sense.
Okay.
And cash flow is generally one of the reasons.
Okay, so let's hold that thought. Now we'll be heading back into our next break, and then when we come back, more about taxation in real estate.
Are you retiring smart? Make your home's equity work for you. With your home's equity and our 30 years of experience, the Retire Smart Properties team can help you achieve the quality of life you've always wanted. Our services are 360 degrees. We'll give you advice, take care of staging and selling, and help you find the perfect home and community to transition to. It's time to enjoy the retirement lifestyle you deserve. Visit our website today to learn how you can use your home to retire comfortably. The Retire Smart Properties team, powered by RE/MAX West.
Okay, welcome back. Now we are in our third session, and we have with us Gurpreet and Amit here. So Amit, you do have a question for Gurpreet?
Definitely. So Gurpreet, we have a couple clients, well, more than a few actually, that are interested in purchasing homes and maybe selling them after living in for 1 year, maybe 2 years, doing renovations. Everyone's on a different case-by-case basis, as you mentioned, but how do we tell if this is business income?
It's a very good question. So the question is, how do we know if it's capital gains or business income?
Yes.
Right.
So there are very specific criterias that Revenue Canada has to determine that. One of them is, you want to look at the frequency of transactions. How often are you buying and selling? And second is the tenure. How long did you hold this property?
Right.
If you held it for a very short period of time, then it may be perceived that it's not capital gains, because capital gains generally means you're holding it for long-term purposes. Right. But again, we talked about extenuating circumstances. That doesn't mean that you have to hold it for a long period of time to get this qualifications, because so many things can happen in life.
Right.
People fall ill, or they have financial disasters or whatnot. You are forced to sell, but your intention was to hold it for a long period of time. So, we want to think about the period you've held it for. Another is nature of trade. Like if you're in the real estate business, you holding a property can be perceived as business income, because you are a real estate agent. You are in the business of buying and selling properties. Right. Whereas you would say, no, my intention is to hold it for, long period of time. Well, it can be perceived differently.
Right. Because we have a little bit of insider knowledge of the industry.
And that really, really makes a difference versus someone who doesn't have that. So all these kind of factors take into play in determining, is it capital or is it business?
Right.
So really and truly, if I am in the business of buying and renovating and flipping, it might be better for me to open a corporation and do my business through that corporation.
Yes
my
and no.
personally?
Again, it comes back to very specific. Can you first qualify for a mortgage in a corp?
Right.
Right, because which
Right.
becomes a little bit different.
Yes.
Secondly, if your intention is to get into that business long period of time, which sounds like a great idea,
Right.
corporation would allow us to use the profits and reinvest it, whereas you can defer some of that income personally,
Okay.
right? But only pay that income within the business.
Uh-huh.
But that doesn't change the scenario if it's capital or business. If you're in the business of renovation, it's still going to be treated as business income.
Business.
Yeah.
Great.
Oh, that's
Okay.
that's interesting. Now, could you shed some light on dividends and corporation? I heard that dividends is being taxed as a far less rate compared to personal. So that's some clients are saying, hey, you know what? I prefer to open a corporation. The corporation does the business. They pay us dividend. I pay less tax.
So first, let me explain what are dividends.
Okay.
So I think that would help. Dividends are proceeds of profits. So what is profit? Profit is anything that you pay tax on. So let's say the scenario where we have a corporation. They had $100,000 in revenue minus $50,000 in expenses. They had $50,000 net income.
Profit.
Yeah.
Yes.
Well, the business needs to pay tax on that.
yes.
So the business has paid tax on that $50,000.
Okay.
Okay, which goes into retained earnings. Now you say I want to take dividends. Well, you're going to take dividends from the profits after tax profit.
Okay.
So let's say you take that. Yes, you get those tax at a lower rate. That's only because we have to keep in mind we've already paid
The
tax
government,
on that.
the business have
Ah,
already paid tax
yes.
on that.
Yeah.
Okay.
So, but the advantage to dividends
Uh-huh.
is, if depending on the nature of business, you don't have to pay CPP contributions. If it was a salary, let's say you take a salary, then it's mandatorily required you have to pay
Okay.
CPP contributions, and depending on if you already have other income, would you want to pay additional CPP or not? So it's very specific. Whereas we might want to say, dividends are better in some scenarios, and in some scenarios we may say, you know what, issuing a T4 or salary is better.
Right.
So it's very specific on case by case basis when and when
Wow.
we don't want to do that. So as you can tell, taxes are very complex.
Yes.
You really need to understand the whole picture, your long-term goals before we can make one decision. So you can't just take what we say and apply it to you, because you really need to think about everything.
Okay.
And that's where a tax professional, I think,
It's what I'm getting is that it's like our suit or our clothes. You could really tailor to fit everyone,
Yeah.
right?
yes.
Yes.
Everyone is unique. And
Unique.
absolutely.
Everything is tailored accordingly. Depends on.
Yeah,
the
the
unique
advantage, I apologize, to end off on the dividends is we get to decide when we want that dividend. That is the key part.
Okay.
Like, say, I don't need the money right now personally. I can just keep it in the corp, even though the corp is paid the
Right.
tax, which is obviously a fixed rate in Canada for corporations at the moment, depending on the level of income, if it's under 500,000 net income. But you can reinvest that and let that grow, rather than if it was personally, now you've already paid the tax, that much less money you have to invest.
Right. So
Okay.
you're
So there-
you're investing this capital and then allowing it to grow, and then you can take it at a later date.
Exactly. So-
Okay. Great
so
benefit.
Wow.
That's why your long-term goals are really important for me to understand and give you that level of advice.
That's very, very important. When it comes to real estate, we know that people tend to buy and keep real estate in the long term. I mean, on a bigger scale of things with management. What's the difference between active and passive income?
So very good question. So active income is anything that you're a full-time in business of. A good
Right.
example I tell them is like a restaurant. Restaurant is a business.
Okay.
And you
Actively
have
involved
staff,
every day.
you're involved, you gotta
Right.
purchase the food, you gotta prepare.
Right.
Passive is like rental income, where you've got this property, you don't go there for a whole year because all the checks come in. It's passively making money.
Right.
Okay.
So in a corporation, passive income is treated a lot differently versus active business income. And active business income is taxed at a lot lower rate. So in real estate, if you are in the business of just renting one property, it would be perceived as passive income. However, there's some very specific rules. If you are in the business and you have a very big business of buying properties and renting them, there are some criteria that you would need to meet, and you can convert that into active business income. And those are very unique situations when that happens.
Okay, so the whole idea for a sophisticated investor, let's say, is to eventually move that from a passive to an active income.
Yeah, so provided they meet the criteria.
Yeah. Well,
Yeah.
what are some of the criteria?
So one of the things that you can make that is if you have a staff, like you have a whole dedicated team, you need to have greater than 5 full-time employees in this business,
Oh,
right?
okay.
Like, it's not just you buying this property. Like, you got to have a team. It's almost going to that restaurant example. You have to have a team, like a business, and you're in that business, and then you would qualify.
You
And
got
then you
one
can-
plumber that's always going to do handyman work, and someone answering the phone when tenants have issues. These are multiple properties, I guess. yeah.
Exactly, but you need to have them on payroll. They cannot be treated
Oh.
as subcontractors.
Good. That's a very good point.
yes.
Yeah.
Well, Must
So that's
be
what I
on
mean.
payroll.
It's very specific to the criteria, and so you have to really follow it closely.
Okay.
Another question many
Yeah.
people have. They're small business people here. I got my principal resident, and I figure I'll take someone said, hey, you know what? Okay, this is the room I'm in. Maybe I'm using it for my business. How does taxation look at that when you're
So-
ready to sell? My principal resident, but I could claim certain write-off for a room,
So
or
what
a
you're
park.
referring to is a home office.
a home
Right.
office. Yes.
Right. Your question is, you're an individual. You use one particular room for a home office. Would this have any effect on claiming this property as principal residence?
Yes.
The answer is no. It would have no impact on you claiming it as your principal residence. In order to claim a home office, there's a whole different criteria to be eligible to claim a home office. It depends on various factors. And under the assumption, let's say you do meet the criteria, you do meet clients at home and stuff like that, then you get to claim that deduction on your personal tax return. You claim a portion of that office and all the utilities and expenses associated with that same proration. You get to deduct that on your personal tax return. It wouldn't impact or jeopardize your principal residence exemption.
Okay.
Adjacent to that same topic, I have clients with more than one rental property, and they always ask me this one thing. I drive there a lot. Can I claim my gas? Can I claim? Can I claim that hammer I bought at Home Depot? What are the specific rules around improving your rental property, or your personal items that you've used to make that rental property better?
So there's some very specific rules on that.
Mhm.
One is, let's say you repaired the roof,
Right.
And you've tore down the floor, you've put in new flooring. So we need to be very specific. Is it an expense or is it a capital expense? So that's where we get a little technical.
Right.
So everybody wants to claim an expense
Yes.
because it reduces your rental income. Whereas the Income Tax Act says, hold on, this what you think is an expense is a capital expense. And if it's a capital expense, such as a roof or anything that makes a house better and it provides a useful life over the years, you
Right.
don't, like, for example, a roof is a good example. It'll last like 20 years.
Yeah.
So, and it costs a lot of money. You don't get to expense that in the year of your rental income.
Oh.
You should add it to the cost of the property, or you can depreciate, as we said, So you add it to the cost of the property. So when you sell, you have your selling price, which is proceeds of disposition, less all your costs. So that leads to my point where I always suggest when you have a rental property, please keep all your receipts, because we can add that roof to the cost of your original purchase
Okay.
price.
Okay, so
right? So it would-
technically, yes.
That's
It's
a
really
very
important.
good, yeah.
Yeah, so it's,
That's-
it's called
that's a
the
good idea.
adjusted cost base.
All right. Okay. So
It would
that's
reduce
important.
your capital gain.
So on that same note, like, would that make a significant difference from a kitchen versus a roof? Would one be?
So just to make it very simple to understand, do you get that benefit in year one, or is it over a period of time? So kitchen is not in year
No,
one.
no,
You
the
know,
furnace, AC,
Right,
roof,
right.
It's long period of
these
time.
things that
You know,
go.
if you have a leaky tap, you repair that. That makes sense to me.
Right.
But if you go and gut the whole kitchen and put a new kitchen in, well, you're not going to get that as an expense. It's a capital in
Oh,
nature.
excellent information, group. Thank you.
Okay, so that's a great area that we touch into. Another area, I have many clients who usually they bought a small home on a big lot, and they are thinking of breaking that home and put a new home on, right? I think that's a different area altogether. What are your thoughts on that? I think after our break we will address that
Sure.
in detail.
It is a very hot topic these
Yeah.
days.
Okay.
It is quite complex and very detailed, and we'll
Wow.
do the best we can and educate your listeners.
Yeah, we have guys out in South Etobicoke and Malton
Uh-huh.
and Brampton. Everyone's doing
Everyone,
it. We got a lot
they're-
of those very large lot sizes, so we'll
Yeah,
address
they want
after
to
the
do
break,
that,
I
yeah.
guess. Yeah.
Great.
Okay, great. So tune in back shortly. We are just heading to break, and we'll be in touch soon.
Hey guys, Grant here from Care 101 Media Group, and this is an outreach video going out to everybody with a request for assistance on your part. As you guys know, there's a lot of devastation that happened in the islands because of Hurricane Irma. There are families that are hugely displaced. Some islands are over 95% inhabitable, and people are reaching out to us, asking us where they can either give products or aid or finances, and at the time we didn't know where to go.
So in order to aid in relief efforts, Care 101 Media Group has started up a GoFundMe page where the community can now go and help submit donations in order to help rebuild the infrastructure that's been damaged due to Hurricane Irma. So, going to the page, donating like at least $5, $10, even $50 isn't very much, but it will help, our Caribbean brothers, sisters, families, friends in helping rebuild their homes.
There's also a call for certain donation items as well, which are personal hygiene products they're looking for. They're requesting things like baby diapers, baby food, clothing, things like toiletry, personal hygiene products, garbage bags, disinfectants, so that they can help with the cleanup. So at our office at 55 Rutherford Road South, Unit 205 in Brampton, we are set up to receive your donations there. So instead, if you'd like to donate some items versus donating money, please come on over to the office here in Brampton. We'd be more than happy to accept your donations. We will be getting it together in about 2 weeks, and I believe the date would be September 21st that we'd like to turn the items over to the Consulate General Office for Antigua, where they'll be shipping it down to Barbuda for distribution there.
Now keep in mind too that as much as it's nice to give toiletry products and stuff like this, they also have to try and get it down there. But a lot of these islands have been so hugely devastated that they need money to rebuild and get supplies and stuff like that. So we're kindly asking that if you can please, if it's $5, $10, $15, $20, please donate, because that's what they need the most. They need to start rebuilding their infrastructure, rebuilding homes, and creating shelters for these people that are displaced. So again, if you can help, we greatly appreciate it. It's perfect here where we are right now, and we can only imagine what families are going through, not having homes, losing all their possessions, and literally not having anything that they know as home around them.
Hello everyone, we're back here with Gurpreet here, just talking about tax tips and tricks and ways that we can help you. Gurpreet, you were just talking about the different issues regarding tearing down a property.
Yeah, so it just seems
Complex
to be...
subject here.
It is a very complex subject, and I don't want your audience to make decisions based on this. It's
Right.
very individual based, so we're just going to be hitting the surface, obviously. But I do want to point out some of the factors that people are not thinking about or that they're not aware of, and it may be very, very important when you're thinking about doing a teardown home.
Right.
First and foremost is it for yourself to live in or not? Right? This is kind of important. It drives
Okay.
so many factors in how the taxes would work. If your intention is to obviously buy the land or the house, tear it down and build a new home and sell. So first and foremost, I find a lot of people don't think about HST consideration. So
Okay.
we come back to the same situation. Pretend you're buying from a builder, right? And now you've actually become a builder if you're building and selling. The rules apply to the same, but now they're applying to you as the builder versus, we have individuals who go to the builder to buy.
Okay.
The biggest one is HST. You talked about HST rebate.
Right.
That is only awarded to the buyer. I built this property and I'm planning on selling it. This HST rules apply here, where the price that I'm selling at is inclusive of HST, less this rebate. A rebate is a very small amount. It's almost like $25,000,
25,
depending on
Yep.
the value
Cap
of the
between
house.
cap
Exactly.
rates.
So let's take a scenario. We purchased land for $1 million.
Right.
It cost $1 million to build, right?
Uh-huh.
We're at $2 million, and the selling price is 2.5.
Right.
Right.
You know, it looks very favorable. Oh, you can make $500,000. Well, let me educate you on HST. That $2.5 million is inclusive of 13%,
Oh,
Wow.
right? So that's
Okay.
almost like $250,000.
Yes.
It's a little more than that.
Right. Yeah.
Right. So you've just cut that in half.
Yeah.
Okay.
Because no one's gonna pay you 2.5 million plus 13% because
Yeah.
all buyers want whatever the market price
Yep.
is, whatever your neighbor's selling. at.
Inclusive. Yeah.
Okay.
Inclusive. So people get hit hard with this HST because they haven't thought about that. So
Oh.
please factor that in. That the selling price is inclusive of 13%,
Wow,
less
wow.
the HST rebate, which happens to be approximately 25,000.
So,
It's a big number.
Big number. So if
Yeah.
I'm a builder, a small builder, breaking a house down and building one house up and selling
We
it.
really need to budget very carefully.
Wow.
We need to plan very carefully. Now, if you are a builder, there's 13% on the selling price, but all the cost to build, wherever you pay the HST, you get to deduct that. I do want to mention
Well, that's
Okay,
good.
of course.
Yeah.
At least that's good. Yes.
that. Yeah, but there's still a significant number to be played.
That could quickly turn into a loss if you didn't plan accordingly.
Very
Uh-huh.
true.
Yeah.
Because when you bought the house, you bought an existing home. Well, guess what? You didn't pay HST on that, right?
Right.
So really, that $1 million purchase price didn't have HST.
No. Wow.
So
wow.
the net effect would be almost $130,000 in this situation.
Okay.
It's a big number.
Yeah.
It's a very big number.
So what happened if I'm buying this home? I'm building this home for myself, not for a sale purpose.
Yeah. So good question. In a situation where you're building for yourself,
Right.
and a lot of I'm finding people are getting to that stage. They want to move up, and they've bought this property. Now they want to tear it down and build a new home. In that situation, because you're buying it for yourself, there is no HST applicable on the sale because you've moved into it. You're living there for X number of years. It qualifies same rules as your principal residence because
Okay.
it has become your principal residence.
Yes.
And if it's not your principal residence, please, you need to consider HST rebate, and you need to think about business income,
Wow.
right? Because if you're in the
Yep.
business of buying this property, building it and selling it, well, it doesn't meet the definition of
Right.
capital gains. So very, very tricky, very complex tax issues involved, and we're talking about big numbers here.
Oh yeah.
And a lot of people have gotten themselves into this problem where they haven't consulted these capital expenditures with advisors. Again, like we talked about, they talk to their neighbors, they'll talk to their friends, but they won't talk to. So tax is very critical when you're making very
Okay.
complex decisions like
Yes,
that.
and we are living in a country where we have to, you know,
Take into consideration all
all
the tax.
of that. Yeah.
Yeah, and there's some really good tax planning. You know, you
That
should think
we
about
can-
before you make that decision to buy or tear down home. So think about the tax, think of the market value. Can you recover that and whatnot? So it's kind of
Gotcha.
important.
Definitely.
Wow. So, Gurpreet, what are some of the major tax problems you came across within a few years when come relating to real estate
For the average.
for the average person?
I mean, this is a really hot subject that we
Yeah.
talked about, which is tear down. The other one I seen quite a bit was the HST rebate, because you know it was relatively new a couple of years ago, as we all know.
Yeah.
So a lot of people weren't aware of that. Now people really understand that. You know what?
Okay.
When you're buying a brand new home from a builder, it's for yourself to live in.
Yeah.
You will not be subject to HST rebates. It's already built into that price. Another area of real estate I find is the capital gains,
Right.
you know, and capital losses, because the industry,
Yeah,
as
the
we know, is
Price market came down quite a bit, so I sell my home and I make a loss.
exactly. So if you've made a loss on your investment property, which happened to be qualified as capital gain or business income,
Yeah.
well, the great thing about Revenue Canada income tax act is, well, if you're taxed on the gain, the losses are also, you can apply to other income as well.
Okay.
So I do want to touch base. I think it's really
Please,
important.
yeah,
definitely.
Let's
So-
do that.
Assume, let's say you purchased a property for long term.
Uh-huh.
It's capital, but now you've decided to sell for other reasons, but you're selling at a loss. So that capital loss gets carried forward, and it can be applied with another capital gain. So keep in mind, capital loss can only be
Okay.
offset with capital
Another
gain.
gain, yeah.
Which is great. I mean, at least you can offset it.
Yeah.
But you can't offset this with business income or other income.
Or no,
That's it.
no income.
Is
Just
it
strictly-
indefinitely?
No, there's limits.
Oh.
20 years.
Mhm.
So, but business
Uh-huh.
business income obviously is taxed at, you report it, but business losses, the good thing is you get to claim 100% of that against business income.
Okay.
So business losses can offset with business income, and capital loss can offset with capital gain.
Okay. So that's good to know. And when you say capital loss, for example, if I sell my stock and I make some gains, I sell my real estate, I make some loss. I guess
That's right. As long as it meets the definition of capital gains, one capital loss can offset a capital gain.
Excellent.
Okay, so it doesn't.
That's
It's not
great.
exclusive to only say, hey, this is real estate or this is only stocks. I guess that's the general rule.
Yes.
Mm.
Yeah, so real estate income or loss is not restricted
Yeah,
to
good.
just real estate, which is pretty cool.
Well, that's great. Yeah, at least it shows that the CRAs they're thinking about us. They're
They're being fair.
yeah, exactly. That's
which
the
is,
word.
Which
yeah.
is what we want.
That's what you want.
Yeah.
Most small businesses, I know, realize that some of them are very good, but some paperwork is very lousy. Bookkeeping, they don't have receipts, they don't have this, they don't have that. And then, when the real time come, they
Then-
get themselves, everything is mixed up. They got money coming in from a rental property to their personal account and everything else. Could you shed some light
Sure.
into that?
But I see a lot of people, they keep the receipts in their pockets at the end of the week. They just throw them in one box, and eventually it either gets lost or don't
Yeah.
have a filing system.
Right.
My advice is when you have these receipts, they should be filed immediately. Right? Don't procrastinate for a later time. That later time is what causes problems. A, you forget what it is. B, it gets lost. If you have a filing system, I would also recommend to have this filing system where you open your mail. It makes sense because the bills generally come in the mail.
Yeah.
You can file it immediately. So, wherever that is, try to keep it at home. In a home office, have a drawer specifically for your receipts and expenses, and it's so easy to do that. At the end of the year, you just take them all together, you tally them up, you got an answer. And anything that's capital, you might want to categorize them into, let's say, if it's for a property, you put all the receipts related to that property in that folder.
Great.
If it's for that business, so you can segregate what's for a corporation,
Right.
what's for personal, what's for investment. So filing is the key. The second is depending on how big your business is, you should invest in a bookkeeper, or you should learn how to use accounting software to your advantage. You should document things. And that's very important. If you start documenting your expenses, then you're going to avail all the tax deductions and expenses that you're entitled to. If you don't have them, now you put yourself in a position where you may not be eligible to claim those expenses.
Wow. Gurpreet, this has been amazing, the amount of information you shared. There's so much things that I don't know myself. I don't realize, and our audience, they're gaining quite a bit. What I'll encourage your audience, please look at this again and please share it. There are a wealth of information. And Gurpreet, if someone need to contact you, how can they get hold of you?
So the best way to contact me is through our company. My company is Ken Accounting. You can visit us on the web at kenaccounting.com, or you can call our office at 905-789-8484, and we're happy to help you. So I do want to say, if you have very specific real estate questions or any tax matters, it's probably best that you call. We can talk to you and meet up with you and see how we can assist you in planning that tax.
Beautiful. In wrapping up, Amit, where do you think the market is going?
Well, that's something. Well, we're live, right? So I can't. Okay. Realistically, the market is definitely it's picking back up now. So over the last 1 month even, we've actually seen sales numbers actually increase when they've been falling steadily since February. So things are definitely they've come down to a bottom out area, and they are trending back on up.
September is very low actually. They had a 35% drop in number of sales compared to September last year.
Yep.
And also we find that there were about 19,000 properties came out in the market, which means it's more of a supply and demand. It's more of a balanced market. We will see that more of the buyers are starting to buy, as you say. They can negotiate better, and it will be interesting to see. I don't think this February will be
like last February, where people were going $50,000 over and $60,000 over. But either way, you know, the major takeaway for today is just make sure you consult your tax professional before making a large real estate transaction.
Yes, just do that. It's very important to contact your tax professional, get professional advice, and see you next week.
All right,
bye now.
Thank you.